Something is happening beneath the surface of the silver market that most investors are completely missing. Not in the daily headlines. Not in the panic selling you watched unfold this week. Not in the talking heads debating whether precious metals are dead or just resting. It's happening in a layer of the market that sits underneath price itself, in the mathematical structure of momentum, and it is signaling something that, if history is any guide, could mark the beginning of one of silver's most consequential moves in years. There is one number at the center of it all, a specific price threshold, a line that, once crossed on a weekly closing basis, would simultaneously trigger multiple independent technical systems into alignment, flipping the dominant downtrend of the past 3 months into a confirmed upside structure. That number is $80 per ounce. We are going to break down exactly why that number matters, what technical signals are already quietly firing underneath it, and what it would mean for silver investors if the market crosses that threshold in the weeks ahead. And this is the Economic Insider Hub. Stay with me through this entire breakdown, because the signal I'll reveal in the second half of this video is the one that almost everyone watching silver right now has overlooked completely. To understand why this moment matters, you have to understand what silver investors have endured since January. At the start of this year, silver was building what looked like a historic momentum run. The metal had climbed above $100 per ounce, a psychological and technical milestone that triggered enormous excitement across the commodities community. The fundamental case was compelling. Industrial demand was accelerating, physical supply was tightening, and the macroeconomic backdrop of dollar uncertainty was adding fuel to the fire. Then January peaked, and what followed was not a simple correction. It was a methodical, grinding, deeply frustrating downward staircase. That phrase, downward staircase, is not just colorful language. It is a specific technical pattern. It means that each bounce from a low is weaker than the last. Each rally peaks at a lower point than the previous rally. Each new low undercuts the prior low. The peaks descend. The troughs descend. The entire price structure steps progressively lower. For 3 months, silver executed this pattern almost perfectly. The peak above 100 gave way to a rally that topped in the mid-90s. That gave way to one that topped in the high 80s. That gave way to a push that stalled in the low 80s. And then, earlier this week, the most recent episode, the crash that rattled the entire silver community, pushed prices all the way down to $73 per ounce. Every time the bulls thought the bottom was in, the market proved them wrong. Every time momentum seemed to be building, sellers showed up and extinguished it. Every attempt at a sustained recovery was met with another wave of distribution. The result, by this week, was a silver market that looked technically broken, fundamentally compelling but technically trapped. A bull case that no amount of physical demand data, dollar weakness narrative, or supply squeeze argument seemed able to convert into sustained upside price action. This is the context in which you have to understand the significance of what one of the world's most respected technical analysts just identified. Before we get into the specific signal, let's establish the credibility of the analytical framework behind it, because in technical analysis, methodology matters as much as the call itself. Michael Oliver is the founder of MSA Research, a firm with 4 decades of documented market analysis. What distinguishes Oliver from the vast majority of technical analysts is not just his track record, though that is substantial, but the specific approach he uses to read market structure. Most retail investors, and even many professionals, rely on standard price-based indicators. Moving averages, RSI, MACD, Fibonacci retracements, trendline analysis drawn directly on price charts. These are useful tools, but they all share a common limitation. They are reactive. They measure what price has already done and attempt to project it forward. Oliver's methodology adds a second layer that most systems ignore entirely: momentum structure. Specifically, he tracks weekly oscillators, mathematical constructions that measure the rate of change in price, rather than price itself. These oscillators have their own trend lines, their own patterns of higher highs and lower lows, their own breakout levels. And critically, they often shift direction before price does. Think of it this way. Imagine you're driving a car, and you want to know when the car is about to accelerate. You could watch the speedometer, that's price. Or you could watch the throttle position, that's momentum. When someone starts pressing the accelerator, The throttle moves before the speedometer responds. Oliver's method is designed to watch the throttle. This distinction explains something that has confused many silver investors over the past 3 months. On the daily price chart, the signals were noisy. Bounces that looked like recoveries faded. Dips that looked like capitulations reversed. The zero line, a common reference point for daily momentum, kept getting crossed in both directions without producing any meaningful trend signal. Oliver's own framing describes these as repeated shin kicks, the kind of false signals that tire out traders and destroy confidence in technical setups. But on the weekly chart, looking at the momentum oscillator rather than price, a different picture was taking shape. Here is the detail that almost nobody has reported on, the signal that was already quietly embedded in the technical structure before this week's price crash even happened. After silver's brief recovery from a late March low, the momentum oscillator on Oliver's weekly chart did something specific. It broke above a multi-point downtrend line, not on the price chart, but on the momentum chart itself. This distinction is important enough to dwell on for a moment. When momentum breaks a downtrend before price does, it tells you that the underlying energy driving the market is shifting even while the price action still looks bearish. The engine is changing direction before the vehicle does. That late March momentum breakout was the first structural signal that the decline from January's peak was beginning to lose its internal coherence. It didn't show up loudly in price. Silver only recovered from roughly $73 to roughly $76 in the weeks that followed. Modest, unimpressive on a price chart. Easy to dismiss as just another dead cat bounce. But the momentum chart told a different story. It said that the underlying force driving price lower was already beginning to fracture. And then, just this past week, even as price was crashing to new lows, the momentum oscillator did something else. It produced what technicians call a higher low. For the first time since the January peak, the momentum trough at the bottom of this latest decline was higher than the trough at the bottom of the previous decline. Price made a lower low. Momentum made a higher low. In technical analysis, this divergence has a name: bullish divergence. And it is one of the most reliable early warning signals of a trend reversal. It tells you that even as price pushed to a new low, the internal selling pressure required to produce that new low was actually less intense than before. The sellers are exhausted. The downward energy is fading. The structure is preparing to shift. 2 independent signals. One in late March. One just last week. Both pointing in the same direction. Both visible only to those looking beneath the surface of the price chart. This is why Oliver's framing is so precise. He does not describe the situation as silver might be ready to rally. He describes the positive indication as something that has already triggered. The technical reversal at the momentum level has already begun. What remains is for the price chart to confirm what the momentum chart has already signaled. And that confirmation has a specific threshold: $80 on a weekly close. This is where the analysis becomes genuinely compelling, because $80 is not an arbitrary number. It is not derived from a single indicator or a single methodology. It is the convergence point of 3 completely independent technical measurements, each using a different approach to evaluate silver's structure. The first measurement comes from the weekly momentum oscillator itself. For the descending pattern of lower highs on the momentum chart to be officially broken, silver needs to settle above a specific level on a Friday closing basis. As of this week, that level sits at approximately $80.50, adjusting slightly lower each week as the downtrend line continues to slope down. Clear $80 on a weekly close, and the momentum downtrend is structurally broken. The second measurement comes from what Oliver calls the 10-week average oscillator, a smooth version of the weekly momentum signal that functions similarly to a 50-day moving average, but applied to the rate of change rather than to price. This indicator, which filters out the week-to-week noise and shows the broader directional bias, shifts from negative to positive at approximately the same level. A weekly close around $80.50. The third measurement is the simplest and in some ways the most powerful: the raw weekly price chart. Over the past several months, silver's weekly closing prices have formed a 3-point downtrend. A line drawn through those 3 declining peaks creates the visual backbone of the technical bear case. A weekly close above $80 breaks that line. 3 measurements. 3 different analytical approaches. 1 convergence zone. In technical analysis, convergence of this kind is not coincidental. It reflects genuine structural reality. When multiple independent systems all identify the same price level as critical, it is because that level truly is a pivot point in the underlying market architecture. Below 80, the technical picture is bearish. Above 80 on a weekly close, the technical picture flips, not gradually, not ambiguously, but definitively and simultaneously across all 3 systems. This creates a binary moment of unusual clarity. Either silver closes below 80 on Friday and every technical signal reconfirms the downtrend, or silver closes above 80 and every technical signal simultaneously validates a new upside structure. There is no middle ground. Understanding why a technical breakout at $80 would matter requires understanding how capital flows respond to technical signals in modern markets. When a major asset breaks through a widely observed confluence level, several dynamics occur simultaneously and feed on each other. First, systematic and algorithmic trading strategies that have been operating in short or neutral mode suddenly receive a buy signal. These strategies, which now account for a substantial portion of daily futures volume in precious metals, are designed to flip quickly when trend indicators confirm a change. A confirmed breakout at $80 triggers those systems across multiple timeframes at the same moment. Second, short sellers who have been profitably positioned on the downtrend are suddenly facing losses. When the technical level they were relying on as a reference breaks, stops get triggered. Shorts are forced to buy to cover their positions. That buying pressure amplifies the upside momentum. Third, longer-term fundamental investors who have been sitting on the sidelines, watching silver's strong fundamental story but waiting for a technical green light before committing capital, finally have their confirmation signal. That pent-up fundamental demand enters the market in a compressed time window. Each of these 3 forces amplifies the others. The result, historically, is that confirmed breakouts from multi-month consolidation patterns tend to produce moves that are significantly larger and faster than the gradual accumulation phase that preceded them. For silver specifically, the fundamental backdrop adds another layer of potential energy to the spring. Industrial demand for silver, driven by solar panel manufacturing, electric vehicle components, and advanced electronics, has been running at record rates. Physical inventories have been under persistent pressure. The macro environment, while uncertain, continues to feature the kind of dollar vulnerability and inflationary risk that historically supports precious metals. None of those fundamentals were able to prevent the 3-month technical decline. But if and when the technical structure confirms the reversal, all of that fundamental energy becomes available to amplify the move. This is why Oliver's framework distinguishes so sharply between technical and fundamental analysis. Fundamentals explain why a move should happen. Technicals tell you when the conditions for that move to materialize are in place. Right now, both are pointing in the same direction. Any discussion of this technical setup would be incomplete without addressing the broader context. Where silver might go if the structural reversal Oliver has identified is real and sustained. Oliver's research, applied to silver's long-term momentum structure and historical commodity repricing patterns, has produced price objectives in the range of $300 to $500 per ounce over an extended time frame. These are not price predictions in the conventional sense. No analyst with intellectual integrity will tell you that silver will reach $400 by a specific date. What they represent is a structural target derived from the amplitude of momentum moves in comparable historical situations. The reasoning behind these targets is rooted in something specific: the relationship between the magnitude of a base building period and the magnitude of the move that follows it. Silver has spent years, in some respects decades, building a long-term base. The longer and more compressed the base, the more potential energy is stored in it. When that energy is released through a genuine structural breakout, the historical precedent suggests the resulting move can be far larger than most observers expect. Whether silver reaches those ranges and on what timeline depends on factors that cannot be modeled with precision. Geopolitical shifts, monetary policy pivots, industrial demand trajectories, mining supply responses, and the always unpredictable behavior of speculative capital. Nobody can give you a roadmap to $500 silver with the precision of a scheduled train. What the technical framework does provide is something equally valuable: a defined entry signal. Rather than guessing whether silver will eventually reach those levels, the analyst's role is to identify the structural confirmation that the move toward them is underway. $80 on a weekly close is that confirmation signal. The distance from current prices, silver sitting in the mid to upper 70s at the time of this analysis, to that confirmation level is less than 5%. That gap is the window. The window between the reversal has begun at the momentum level, and the reversal is confirmed at the price level. Historically, that gap is where the most favorable risk-reward entry points exist. After confirmation, the move is clear, but so is it to everyone else. Before confirmation, the uncertainty is real, but so is the potential for capturing the full extent of the structural move. For silver investors trying to navigate this setup in real time, here is the practical framework Oliver's analysis suggests. The most important data point is the weekly closing price every Friday. Not the intra-week high, not the Monday opening, not the intraday spike to 81 on Wednesday. The Friday 4 o'clock close. That is the only number that matters for confirming or denying the breakout. Oliver's methodology is built on weekly closes specifically because they filter out the intra-week noise that destroys so many trading decisions. Second, monitor volume. A push toward 80 on rising volume, particularly if accompanied by increasing open interest in silver futures, signals genuine institutional commitment behind the move. Algorithms and systematic funds moving into silver tend to show up first in volume data before price catches up. A push toward 80 on thin, low-conviction volume is a setup for a false breakout. Third, watch physical silver indicators. The spread between paper and physical silver, the reported inventory levels at major depositories, and the lease rate market for silver lending all provide real-time information about whether the physical market is tightening in ways that could amplify any technical breakout. Fourth, track the US dollar index. Silver's relationship with the dollar is not a simple inverse correlation, but at macro turning points, a dollar in structural decline removes a significant headwind for precious metals and allows technical setups to resolve more cleanly to the upside. And finally, watch the broader precious metals complex. Gold's behavior relative to silver, the gold-to-silver ratio, can provide early confirmation of whether institutional capital is rotating into silver specifically, or whether silver is simply moving with gold in a broad precious metals bid. Silver investors find themselves at a genuinely unusual moment. The price action of the past 3 months has been brutal. The crash this week has been psychologically difficult. The narrative surrounding silver, the safe haven story, the industrial demand story, the monetary hedge story, all seem to be losing credibility in the face of relentless selling pressure. But beneath that surface narrative, a different technical story has been quietly assembling itself. A momentum downtrend broke in late March. A bullish divergence printed just this past week. 3 independent technical systems are converging at the same price threshold. And the distance between where silver is trading right now and the level that would confirm a new structural uptrend is less than 5%. This is not a guarantee. Technical analysis never offers guarantees. The breakout could fail. Silver could revisit the $70 zone before finding structural support. The macro environment could shift in ways that delay any price recovery. These are real risks that any honest analysis must acknowledge. But when 4 decades of documented technical methodology, applied to a specific market at a specific moment, produce a signal this defined, a convergence of momentum structure, average oscillator, and price downtrend all pointing at the same threshold, the attention of serious investors is warranted. The opportunity is not in reacting after $80 breaks. By then, the algorithms will have already bought, the shorts will have already covered, and the fundamental investors will be chasing a move already underway. The opportunity, for those willing to study the technical structure carefully and act on what it reveals before the broader market does, is available right now. Watch the weekly close. Monitor the volume. Keep your eye on $80. If silver closes above that level on a Friday in the weeks ahead, the technical case for a historic upside resumption becomes structurally confirmed. And when that confirmation arrives, you will look back at this week. Silver in the 70s, 3 months of painful consolidation behind it, one specific price level less than 5% away, and recognize that the signal was there for anyone willing to look below the surface. This has been the Economic Insider Hub. If this analysis gave you something to think about, Hit the like button and subscribe so you don't miss the next breakdown. Drop your read on silver in the comments. Are you adding before the test, holding your position, or waiting for confirmation? I read every single one. See you in the next video.